Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, here to help you maximize your cash flow. Today is our whole life illustration day and policy review. We're going to be reviewing a PennMutual life insurance policy that one of our viewers sent in. And yeah, stick around. If you've got any questions as we're going through this, put them in the comments and we'll respond. Do our best to answer every question we get. If you're watching this after the fact, still leave your questions in the comment. I always try and respond to everything. Our goal, full transparency, help you understand the ins and outs of these products so that you can decide if they're right for your situation. If they are, I'm happy to help you. If you need an agent, and if you don't, you're at least going to get information from the things you find on my channel to make sure that you get a properly designed policy that matches your needs. Let's jump into this. We're going to share our screen here and take a look at this Penn policy. All right, here is the PennMutual policy. So we can see the date. This was issued December 3rd, 2021. The base face amount, $179,985. This is important. When it comes to a PennMutual policy, the overall death benefit is what determines the Mech limit, not just the face amount. So we're going to see that there's a bit more death benefit than just this amount. But this is basically what you see when you look at a policy. They always like to show you what the base face amount is. The rest of the death benefit is made up of annual renewable term insurance. That annual renewable term insurance generally doesn't affect the target premium. Okay, that's in whole life and in IULs. That term insurance that gets blended in is designed to get blended in to reduce the agent commission, give you more cash value. So let's take a look and see how this policy is designed. There's a lot of pages to this policy. I think we've got 111. This is the actual policy. I redacted all of the personal information on this, but let's just hop to the illustration that was attached with the policy. Should always have, as part of your policy packet, the original illustration. It may or may not be a max funded design matching what you hope to pay into it, but it's what underwriting approved. Okay, in the case of PennMutual, not a whole lot of flexibility, so generally this policy is designed exactly how you plan to fund it. There is some wiggle room to be able to increase what you're paying into it. It's very limited, similar to a MassMutual policy where you can increase it on your anniversary date by a small amount without going through underwriting, generally up to 10%. Anything more than that, you got to go through underwriting. Okay. Outside of your policy anniversary date, you can on your policy anniversary date, you can also catch up on paid up additions you didn't make in prior years. Actually, it's just the year before. So they don't allow you to catch up 2 years prior. You can catch up on the year before prior. So there's some complications when it comes to flexibility in this policy. In general, I look to sell a Penn policy if somebody does not need flexibility in their premiums. If they have a set amount that they know they're able to pay in and they can commit to it, this can be a really good policy for them. So let's take a look and see how this one was designed. Okay, so we've got an initial premium, $20,000. $539,954 is the total initial face amount. Remember at the beginning, the base face amount was like $179,000. We're going to see that number again in here in just a minute. Okay, this is a quick summary of what to expect from premium payments and potential growth based on current dividend rates. PennMutual's current dividend rate, 5.75%. And here we go. So here's our base face amount. This indicates our design right here. Base face amount. Then we have a flexible protection rider. This is the term insurance blended in, $359,000. Now, PennMutual gives you the opportunity to essentially blend in 2 riders that make this policy act similar to an increasing death benefit that you see in an IUL. And if you watch my channel enough about IULs, you understand what I mean when I say increasing death benefit. Our options are increasing death benefit or a level death benefit. Okay. An increasing death benefit, the death benefit is going to go up as your cash value goes up. Okay. A level death benefit starts out level and the cash value rises up to it until it gets to a certain point, and then they both have to start going up. Okay. In general, an increasing death benefit is more efficient. You pay for less insurance up front, so you end up with more cash value. And we tend to see that from these types of policies. So this flexible protection rider, it's not the current case with how we design a PennMutual policy right now, but at the time that they did this, you were allowed to do 2 times the base face amount on this flexible protection rider. Now it's a 1-to-1. So the best designs that we can see now, we see 179 for the base, and it would be 179 right here under the FPR as well. So it's a 1-to-1. This one is a 2-to-1. This looks like they did the full 2-to-1. Good job. Whoever, this was not my client. Okay. Another agent did this policy. This is how we would design it with the FPR. We would do the 2-to-1. This gives them the highest Mech limit because it's based off of this total number here. And the commission is essentially based off of this number. All right. And this is the biggest split that you can do. So this agent designed this to minimize their commission. Let's see what else we can gather from this. So this is a terminal illness rider. That's standard. Most of your policies will have that. Chronic illness rider as well. We tend to see both of those 2 riders on most insurance policies these days. Okay. There can be some times that it's excluded, but generally we see those on most. Now, the unique thing about a PennMutual whole life policy, I really like this. They are one of the only ones I've seen that offer an overloan protection rider in the whole life policy. That is usually exclusive to an IUL. Don't generally see that. That's one of the reasons I like the PennMutual whole life policy. Much better than I like their IUL. Just in general, it's a very strong cash growth product if it's designed properly. And you get the overloan protection rider, which we don't generally tend to get. Okay, so this is that second rider I was talking about. They give you 2 riders. The second rider works in conjunction with that FPR rider that allows this high premium design above the base for a long time. And you can basically state how long you want that rider to stick around. In this case, they chose 20 years. Now, generally, you're going to pick this number based on how long you think you might actually fund this policy. In general, you don't have to limit that. You don't have to limit it to 20 years. You can let that thing keep running as long as it doesn't create a Mech. Now, it's possible that with this design, that it created a Mech if they didn't stop it after 20 years. Okay, but most likely they could have gone 30 or 40 years with this thing, if possible. But what we can tell from the premium payment, the scheduled premium payments, this client isn't interested in paying for that long. So I don't have an issue seeing this at 20 years. Now, in general, I do prefer to leave the flexibility that you can fund it for as long as you want to, because most likely, if your income continues to grow and expand, and this performs as expected, this is going to be a great place for you to put your money in as the first step every single year. So while you may go into a policy thinking that you're going to stop funding it after a short period, I think that's going to change when we see the overall financial environment and the risks that are present out there and what we get inside these policies. You're probably going to be pretty happy continuing to fund this thing, knowing what it's doing for you every single year that you put new money into it. Okay. So something to think about. You may want to leave yourself some flexibility to keep funding it as long as possible. So the EPPUA, there's actually two choices that this agent had to blend in with that flexible protection rider. The first one is this enhanced permanent paid up additions rider. And the second one is called the accelerated permanent paid up additions rider. So we have the EPPUA and the APPUA. You have to choose one or the other if you want this type of design. In general, I usually choose the EPPUA because that gives us the longer funding period. If you use the APPUA, that one's generally better if you have a shorter funding period. So if you plan on just funding it for 7 to 10 years, if you use the APPUA, you're going to end up with more cash value in year one and more cash value long term. Okay, I don't know why. That's just how it works. When we play around with the numbers, the APPUA is what we use for short-term accelerated funding or overfunding, and the EPPUA is for longer term. Let's take a look at what the funding was for this one. What was the plan here? So here's your premiums. Oh, something to notice here. So we have an annual premium. If you opt to pay monthly, you can see it increases your cost by about $250 for the year. So in general, on a whole life policy, I do prefer to make annual premium payments if you can. You can change these. You don't have to do it the same every time based on what you choose when you first start the policy. So if you have the ability to fund it on an annual basis, I think you should. If you can't, fund it at whatever you can. You can see if you go semi-annual, it adds $120 approximately. At quarterly, now we're up. Basically, actually, that's funny. It charges you more for quarterly, slightly more, 4 cents more for quarterly than it does if you do monthly. That's unusual. Usually it's a little bit less. Usually the quarterly is like right in between these two. So in general, if you can fund it annually, you should do that. It's not the case in an IUL. In IUL, you don't get charged extra fees for making monthly payments as opposed to annual. You might not get the same growth. You might not get credited with the same amount of growth. Your growth might get prorated, but they don't just charge you extra for it. Now, there's a reason that whole life charge you extra for it. They charge you extra for it, and it doesn't quite make up for it, but they charge you extra for it because if it's scheduled premium, they apply it as if you put it all in at the beginning of the year. So you're going to get your dividend growth based on putting it in at the beginning of the year, even though you didn't. Okay. So that dividend growth that you get from it will offset some of that $250. It's not going to offset all of that $250 though. So that's something you'll want to take a look at and decide what's best for you. This client got a standard non-tobacco rating. Policy loans. Okay. With PennMutual is a direct recognition company. When he started this policy, the current rate was 5%. PennMutual's direct recognition policy for the first 10 years, so I'll just say it operates very similar to a wash loan in an IUL. For the first 10 years, you're going to have a net cost of 0.65%. So in this case, they would charge him 5% in that first year, and he would get an offsetting credit of 4.35%. After 10 years, it washes. The loan rate is variable, so it's going to go up and down based on what the actual rates are out there. But you're going to get an offsetting credit that's 0.65% below that for the first 10 years, and it will wash after 10 years. So not a bad deal. I actually like their loan option. The alternative is like Guardian is slightly better in that you get a wash rate right out of the gate, but not a big deal. I mean, in the early years, hopefully you're not borrowing everything out of it. And if you are, it should be worthwhile. For the most part, the bigger impact is going to be later on when we've grown a ton of money in these policies and we're going to be borrowing them out in retirement. If we have that wash loan in retirement, awesome. The current rate, by the way, 5.7%. So 5.7 cost to borrow, 5.05 credit. Offsetting credit is what you would get in a PennMutual policy right now. Okay, a little bit of information about reduced paid up. That's important because this illustration actually illustrates a reduced paid up. Here's the Mech limit. So the Mech limit is actually 22,211 or 22,111. Remember, we have the funding at 20,000. So he does have some room to increase the funding. So this isn't precisely optimized for the amount he's planning on putting into this policy. You could have reduced the death benefit just a little bit. It's a pretty minimal impact. Okay. Could have saved a little bit of money if you dial this in nice and tight to that 20,000. Okay. It's not a big deal, I don't think. The cash growth difference is going to be pretty minimal. But just know that this was close. Okay. What we don't want to see, is a Mech limit of like, in a policy like this. It's totally different with Guardian, and we'll go over that when we go over Guardian Mech limits. But what you don't want to see is like $1 million in death benefit that gives him a Mech limit of $40,000, and he's only putting in $20,000 a year, and had no plans on putting in more than that. That's what I consider a bad design because it's not meeting the client's needs. I've had clients before that said, oh, I've got $1 million in death benefit, and they're putting in, $6,000 a year into a policy. And I ask them why they have $1 million death benefit. Like, what was the conversation? What did they tell the agent that sold them that policy what they wanted? And they said, well, I said I wanted something with good cash growth. And they recommended that I have this $1 million. And I said, why did they recommend $1 million? And they said, because the agent said that that's what a lot of people get. So there was no reason to have $1 million. The client wasn't interested in $1 million death benefit. They were interested in cash growth. And they were given $1 million, which carries way too high of a Mech limit for what they're planning on paying into it. And it just drags on the cash value in the policy. So be sure, if you're an agent out there and you're watching this, be sure that you're designing it to meet your client's needs. Okay, if we design these policies to meet our clients' needs, they're going to be happy. They're going to refer people to you. They're not going to get on YouTube and watch videos and realize that you sold them a bad design policy for what they're trying to do. You might have got them in the beginning, and you might have got that commission, but it's not going to be worth it in the long run, in my mind. Okay. Got to make sure you're in this for the long haul, designing these policies the best way that we can for our clients. And my guess is if you're here watching this, you're trying to do that. You're trying to learn and get better. We get a lot of agents that watch our channel, which is good. All right, let's see what else we can glean from this. Okay, here's our basic ledger. Here's your breakdown. So here's the base contract, the FPR, and then the EPPUA. We've got cash value on the non-guaranteed basis. I generally like to look at the non-guaranteed as opposed to the guaranteed. Guaranteed is nice to know that it's there, but like PennMutual has been paying above and beyond the guaranteed rates for 150 plus years. So I don't think there's any reason to assume that the guaranteed rate is going to track, because the guaranteed rate assumes no dividends payout ever in this policy. Okay. In this case, we're going to skip past this one. We're going to go to another one. This one has them continuing to pay this $5,000 premium, and that's not actually the plan that we can see in this policy, but it looks like they'll have the ability to continue paying into it at $5,000. What was that one? The flexible Flexible protection riders exceed the FPR coverage amount in policy year 36. Non-guaranteed values avoid a Mech. Okay, so it doesn't tell us that there is a Mech here, which is good. In general, we like to see a design that doesn't have a Mech, even in the basic ledger, and not only in the non-guaranteed current one. In this case, it looks like there's 7 years of payments at 20,000, and then it drops down. Like that's the plan that it looks like in here. Now, as a percentage basis, for cash value in year 1, right here, we're at about 75%. That's pretty normal for a PennMutual policy. At this time, when he started this policy, if you have the top health rating and you had the best design, you could get right at 80%. Okay, maybe 79, something like that. So with a standard health rating, which is what this person got, being at 75% looks like it's right on. Like this is a good design policy. And really to get up closer to that 80%, you would use that APPUA rider, not the EPPUA rider. Okay. But that's going to limit how many years you pay into it. Right. So let's look at the current ledger or the supplemental ledger. So this is the actual plan. Okay. Generally your supplemental ledger carries the actual funding plan that you and your client came up with, or you and your agent came up with. And we can see that there's a plan to do 7 years of payments of 20,000 and then nothing after that. Okay. We've got a little 1 marked right here. And when we go down here, we can see that that means they illustrated a reduced paid up option in year 8. A reduced paid up option in year 8 turns off the premium, so there's no drag. It is an efficient design if you plan on stopping your premium payments after year 7. Now, the only thing that I would suggest that they should have considered doing, if this is the actual plan, if the client definitely thinks that they're going to exercise a reduced paid up in year 8, I would probably look at that APPUA rider instead of the EPPUA rider. Okay, remember, if it's between like 7 and 10 years, that APPUA rider is going to generate more cash value for you in the beginning and throughout the life of the policy. Everything else functions almost the same. It's just a slight change in how that gets calculated. So if we look at this plan and the plan is to stop funding it here, that was the only change I would make. Otherwise, this is a really well-designed policy. We've got strong cash values. We've got a break even that happens in year 6, which is typical for a standard non-tobacco health rating. Okay, especially with PennMutual. PennMutual is going to generate less cash value in year 1 than a company like Guardian. Okay, but it gets stronger pretty quickly. PennMutual is very strong on cash growth, especially with how we do the designs. PennMutual attributes more of the dividend to paid up additions than a company like Guardian does. Okay, they don't have the flexibility that Guardian does, but you end up, if you're able to get a policy and you don't need the flexibility, you're going to end up getting more credit on all the paid up additions with a PennMutual whole life than you will with a Guardian one. Now, I still sell more Guardian than anything as far as in the whole life space. And that's because that flexibility is huge. There's not a big difference in overall cash growth. I mean, there is in the long term, but not in the short term by any means. Like Guardian's probably going to be just over 80% cash value in year 1 with a very similar policy like this, or right at 80%, where this one's at 75%. They get very, very even around years 5 and 6. This one pulls ahead, but it takes a number of years for it to really start to pull ahead. So there's a lot of factors involved in that, but you can always get an illustration on both of them and compare, and use that information to help you decide what policy might be best for you. As far as this policy goes, I'm going to give this agent an A for this policy. This was very well designed. There was only one quibble, and it's very, very minor, and that's the APPUA as opposed to the EPPUA, based on what it looks like the client wanting to stop funding it in year 8. So, the person who sent this to me, I imagine you're going to watch this video if you're not watching it now. Reach out. Let me know if that was your actual plan. The other thing, of course, is I don't know what conversations they had with this agent, but I would hope that that agent talked to them about the ability to continue funding it if they want to. So we can see this person's 44. I don't see any reason necessarily to stop funding it at 50 if they continue to have the ability to fund it. And so that EPPUA rider might be the best choice in this case, if that was part of their conversation. Okay. Sometimes people just want the ability to fund this very quickly and not have that ongoing commitment. It's a lot easier to make a commitment like that if you're not locked in for 20, 30, 40 years of big premium dollars. Some people just feel more comfortable with that. This might be their first policy that they've gotten, and they're just dipping their toes into it, and this was a design they were comfortable with. I'm totally fine with that. This could be an A+ design in that scenario, especially if it's their first policy, like I just suggested, and the agent assumes that they may end up wanting to fund it longer, but the client isn't sure. So using that EPPUA rider, I think gives them some flexibility there to continue making some of these payments longer. Remember, that EPPUA rider sticks around until year 20. So it's possible that this policy could be funded at $20,000 a year through age 63 without a Mech. That's incredible. That's a lot of nice flexibility built into this thing. And hopefully the client is successful in this and they're able to continue funding that and do the reduced paid up later, or maybe they don't end up doing the reduced paid up at all, right? Because realistically, the older you get, the better these base premium dollars do inside of a policy like this. Every time you throw in that base premium, more and more of it turns into cash value each year you get older. So that base premium is getting more efficient. Once we stop funding our paid up additions, that base premium is going to be looking pretty good to be able to keep funding it. So as long as you have the ability to keep funding it, you may want to consider doing that. Let's see if there's anything else. I think that was about it. That's just this just assumes a dividend that's 0.25% lower than the current dividend rate. Let's keep going. That's it. That's the end of our policy. So potentially A+ on this design. This person got a good policy. I'm pretty happy with this. I think they'll be pretty happy with it, especially if they can fund it as planned. I'm just going to scroll back up here. Make sure I didn't miss anything. If you see anything in this that I didn't address, put it in the comments section. I'll either answer it there or make a follow-up video. Most likely, I think we covered most everything, so I'll probably just answer any questions in the comments. Are you guys getting any value out of this? Let me know. Let me know in the comments if you appreciate this. On Tuesday, we do IUL illustrations and policy reviews. So be sure to come back, set your notifications. It should already be up. You can set a notification where it'll tell you that we're going live. Oh, this is important to look at. This rider will automatically terminate if cumulative EPPUA premiums made within the previous 5 years are less than the rider payment requirement of $7,280. So you got to make sure that you're putting in a minimum of $7,280 under this rider. Now you can put in a total of $14,000, and that's part of the plan. This $14,000 along with the base gets you to $20,000, but you need to put in a minimum of $7,280. Now, if you put in $7,280 instead of $14,000, let's say in year 3, and then in year 4, you do the same thing again. In year 5, you cannot catch up to that payment that you missed in year 3, but you can catch up with the one you missed in year 4. And because you're still above that, you don't have to worry about that rider going away. So there is a little bit of flexibility in these policies, but you can lose that flexibility if you don't fund it properly. That's one of the reasons why I like to say, don't really look at this if you expect to need that flexibility. If an emergency happens and you need that flexibility, fine. That's what that's there for. Okay, but this is not a policy designed to be flexible where you're just going to change your premiums constantly year to year. Oh yeah, right here it tells you from policy year 3 through 22, you may catch up on any shortfall that existed during the previous year without additional underwriting, but you can't go back more than 1 year. Maybe you could with additional underwriting. Okay, but that's usually the case. Most of these policies, MassMutual, PennMutual, you can increase coverage, you can add extra dollars as long as you go through underwriting and get approved for it. Because most of the time, the attitude that these companies take is, why are they trying to get more insurance right now? Did something happen? Was there an event, a health event in their life that makes them think they need to buy more, as opposed to what we like to do, which is just keep buying more because it's turning into cash value that we know is going to be in this nice, safe growth environment. But from the insurance company's perspective, they've got to be skeptical. Oh, this is interesting. Okay, so the dividend amounts for payments made on a monthly policy anniversary will be prorated according to the proportion of the policy remaining. So they aren't applying it at the beginning of the year. See, I don't have a PennMutual policy yet. I do plan on getting one. But my Guardian applies it as if it was from the beginning of the year. I can see in my account that it shows that full payment being made at the beginning of the year. So I had assumed that this one did the same thing. That's what we get for making assumptions, huh? EPPUAs can only be made on monthly policy anniversaries. All right, I think that's it. I think we covered that pretty well. So I appreciate you joining me. We'll be back again next Tuesday live with a National Life IUL. If you have a policy or an illustration that you'd like me to review, my email is right there below, scrolling along the bottom. And my Calendly, if you want to just have a meeting with me, if you don't want me to review it live, but you want to meet with me to do a review, we basically do what I just did. We'll just go through it. I'll tell you my thoughts on your policy. You can sign up for a Zoom meeting with me right there with that link, my Calendly link. If you want to meet with me about anything else, if you just would like to get an illustration, learn more about what might be best for your situation, if you're shopping around for a policy, I would love to help you out. Definitely keep educating yourself by watching my videos. There's a ton of information out there. And like I said at the beginning, our goal is transparency and education. I want you guys to know as much as possible about these things so that whether you're going through me or somebody else, you understand what these policies do. You understand what makes up a good cash value design. That may or may not be your ultimate goal, right? Most of the people I work with, our goal is highest cash value possible for them. And so that's generally what we design around. Usually that also gets us the highest death benefit as well. There can be some exceptions. There can be some exceptions to the designs that I generally share with you guys being the best design for you, but it's very, very rare. Okay. So be careful out there. If you're shopping around, be careful buying into other agents that might justify doing a much higher commission design that you don't actually benefit from. It's not that I don't like commissions or I don't like money. I do. I'm just like everybody else. But even more so, I want a policy that you're going to be very, very happy with for decades and will ultimately meet your financial needs. So that's our goal here. And with that, we're going to end this broadcast. Appreciate you joining me.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.